you're still requiring some math, even if it's not good, even if there's faults to it. It's not elementary school math. This is not addition and subtraction.
Math is not necessary for risk, and stop losses are not a good risk management tool. What do you think, The way the business was run is they would play with this money, and they got caught, with their kind of pants down with all these illiquid tokens, and they couldn't fulfill these withdrawals.
All right, welcome back to Investing Counterpoint, everyone. And Daniel, we have an exciting one today.
Yeah, this is one of the reasons you will see today why you need to understand risk management. Why people sometimes say, why do you need this risk management? Why do you need math? Well, and why do you need logic in this? You can just invest in an index fund or something that the press says that you should invest in, but that is not a good idea. We'll talk about that today. So
we're talking about a different kind of risk management today. A little bit. We're talking a little bit of a different kind of risk management, and this one that I always thought was when I was an allocator a little bit underlooked. This is more like an operational and due diligence risk management. So this is like we're not talking about putting something into our machine necessarily and seeing what happens. We're talking about digging deeper into the actual underlying mechanisms that operate this machinery. So this one's a really interesting one, and it's a real-time lesson in more operational risk management than in financial risk management even.
Yeah, let's start by sharing a couple of videos, and we're going to comment. So this will be a slightly different. I don't know if you've seen this one. This was we're going to talk about FTX, of course.
Well, yeah, let's tell them what we're talking about first before we jump
I think
in.
everybody knows this, right? FTX collapse, many billion dollars gone. Who knows where they are? The liquidator in charge of bankruptcy is a gentleman who did Enron. He said that he has never ever seen anything like that in his life. The complete absence of records. So we're going to show you. So this lady was a head of Alameda Research, which was the hedge fund arm of the FTX. Believe it or not, that exchange had a hedge fund arm, which I think is not super usual. But what you're going to hear, this is going to start with risk management. Our blog is about risk management. You should subscribe if you're interested in risk management. Let's hear what she has to say.
Yeah, absolutely could pull it off without my math degree. Use very little math. Use a lot of elementary school math. Being comfortable with risk is very important. We tend not to have things like stop losses. I think those aren't necessarily a great risk management tool. I'm trying to think of a good example of a.
So anyway, I think that's okay to start with. So what do we have here? Math is not necessary for risk, and stop losses are not a good risk management tool. What do you think, I'm
going to go false on both cases. False statement. So first of all, math is the underpinning of risk management. Risk management isn't. I mean, we don't need to get into that in this webcast, but that's a ridiculous statement. I mean, I've seen, even when I talk about a bad risk model, this is something that still requires math. I mean, you're still requiring some math, even if it's not good, even if there's faults to it. It's not elementary school math. This is not addition and subtraction. There's much more at play here. This is not elementary.
This is a hedge fund that did crypto derivatives, some of the more complicated interests out there. So because you're talking about derivatives, which are difficult enough, there's a lot of math, but then you're also talking about crypto, which is very difficult to understand.
I mean, the whole thing's based on math. The whole crypto is based on math, right? I mean,
yeah. So basically, what she says is that you need tolerance for risk. That's all you need for risk management. It's all purely psychological. You know what that reminds me of a little bit? Sometimes people fixate on risk as risk tolerance. Like all you care about is how tolerant you are of risk. In a very simple way, that is what kind of she's saying.
Yeah.
She's saying that, well, it's all about you being able to handle risk. Do you have the makeup, psychological makeup? And that is therein lies the peril, I think, of relying on purely risk tolerance questionnaires for advisors that they do.
How much can you take?
Exactly, because in times that the markets are up, that's what it seems like. It's like you just got to be able to stomach more risk, stomach volatility. But then when things unravel in 48 hours, all of it is gone. And then you're like, realize, oh, you know what? It's not just about psychological willingness to take risk. Of course, that's not the only reason that that this whole thing unraveled, but it is a reason. So to set the stage, right? We're talking about FTX crypto exchange collapse and Alameda Research, which is their hedge fund arm. In a very basic way, the way this worked like a Ponzi scheme. And in fact, we'll show you a video in a little bit where the founder admits that it's a Ponzi scheme on air, like a month before this unraveled. But what they did was they had an exchange, which is FTX. It's a crypto exchange. Then they issued a token, a crypto token, which is called FTT, I believe. And so this token, I don't know what value it was supposed to have, but it was supposed to have, so there was some story behind it. But the idea is that somehow, and I don't know if this is allowed, they were able to use this FTT token to put it as collateral to borrow money from investors, from their own investors in the exchange, from their own users. So they put up this FTT token collateral, they would borrow that money, they would play with that money. Now they would play with on FTX exchange. It would drive up the volume. So FTX exchange came out of nowhere, became number 2 exchange in the world. And of course, as the volume of FTX went up, FTT token also went up because there's so much money being traded on exchange and FTT token dependent on it. So it was a very circular pattern, right? And so that in itself is problematic. Clearly, right? I don't know the exact regulations and laws here, but this is problematic. But then on top of that, what happened was after the collapse of another cryptocurrency called Luna, Sam Bankman-Fried was basically going around buying companies. So he used this FTT again as collateral to do leveraged transactions to buy up. He was buying up the whole crypto world, right? He was buying up companies left and right. And it only by accident that this FTX unraveled. If this didn't unravel, and I'll show you, I'll explain how it unraveled. He would have been like Elon Musk in a year, my prediction, maybe even, and I'll show you later an article about him, well, one of the journalists, where they said that this journalist, a very experienced financial journalist, said that after speaking with him, I came away convinced that he's going to be the first world's trillionaire. That's what the article says. Okay, so how did it unravel? It unraveled very, very simply because he was competing with Binance, which is another crypto exchange, number 1 exchange in the world. Binance has recently moved to Dubai, but it's originally a Chinese project. And it is a very powerful company, but it also is a very prudent company. It's run, as far as I know, it seems like they hold a lot of secure assets and they're not over leveraged, which is what in this situation is very, very important. And so somehow or other they had an argument. And what's interesting about this is that
Binance and FTX had an argument.
Yeah. Binance was the original investor in FTX. They invested something like $900 million. And so they had some argument, and the CEO of Binance, his name is CZ. He's a long Chinese name, but they call him CZ. Just like the founder of FTX, they call him SBF. He's a Sam Bankman-Fried. But interestingly, both his parents are Stanford Law School professors, which I don't know what that means. But CZ was not happy with SBF trying to go around him somehow. And he just tweeted, you know what, I'm just going to sell these tokens and see what happens, because nobody ever sold them. They just always went up. And that's what happens when he sold them. In about 48 hours, that whole business was gone. Because
what was the business worth? Was it 40 billion? Was that the estimated worth?
Yeah, I don't know what his personal estimated worth. I mean, I think it's very fluid, right? You can value it in different ways. But I don't know if it was 40, but
he couldn't handle that. The exchange couldn't handle a fraction of that, essentially value.
Oh yeah.
Redemption.
They ended up so they had liabilities of billions of dollars at least that came due essentially. But reality, maybe tens of billions, but billions for sure. But they only had maybe a few hundred million at best. And then most of their stuff was illiquid, and they couldn't really manage it. And of course they couldn't, right? Because the way the business was run is they would play with this money, and they got caught, with their kind of pants down with all these illiquid tokens, and they couldn't fulfill these withdrawals. So they tried to get a bailout. So they went back to this Binance, said, you know what? I'm sorry, forget all this. Why don't you bail me out? And Binance was actually stepped in. They were supposed to bail them out, but then they looked at the books, and basically they didn't find any books. That's the point. There was no book. And Binance said, you know what? Our due diligence showed we can't do this, and they let them go down. Of course, it triggered a lot of processes in the crypto space, which I think are healthy, by the way. Here are the healthy, before we talk about risk management and show you some things, here are the healthy conclusions, I believe. First of all, in Bitcoin, things like Bitcoin are real crypto. There's a saying, your key is your money, not your keys, not your money. When you try to play crypto space for speculation, and you hand your keys to various entities, you're essentially no longer in the crypto space, you're in a Ponzi space. You should own, if you want to use cryptocurrency, you should custody your own keys, or you should have a very trusted party audited. And I don't know what that means. FTX was also audited somehow, but you should know.
So is Madoff.
So is Madoff, yeah. But you should, not audited, but like audited by you. So they should be willing to prove to you what are the keys, where are these coins, so you can monitor them on the blockchain. None of this was true here. People really got punished for greediness. They would earn on this Ponzi scheme, on this flipping, and it just so happened that it blew up. My opinion, if it wouldn't blow up, then he could reach what's called escape velocity. You would have so many investments into different businesses. When crypto would turn positive, he would just no longer be able to blow up. So I don't think it's a bad thing. I think it's a good thing. I think you need to understand that the difference between FTX and all those things and Bitcoin, right? And when you look at the project like this, you need to understand, if you're investing crypto, which I think crypto is a very interesting investment. I think it solves a lot of real world problems, but you need to do your homework. And I'll show you one video. If you did your homework on this project, on this podcast, he talks about how he did what's called yield farming, which is a complete, baloney in the crypto space. He did yield farming. And he was explaining how it works. Basically, he started by saying, imagine you create some token, and he likened it to a box. It's like a box, right? Which already, when you hear a word box, you should be wary, because there is the black box. He was talking about a black box. You don't know what's in the box. You just know that it's a lot of celebrities are endorsing it. Tom Brady, which seems like a very good guy. And I don't blame these celebrities. Celebrities endorse crap all the time. In fact, I think when you see a big time celebrity endorsement, you should run from the project anyway, because they've spent a lot of money on something that doesn't add value to anybody, right? They spend a lot of money on somebody who plays baseball or basketball or football. We have no clue to just endorse the project. So it's nothing to do with Tom Brady or other people who are involved in this. It should be a sign for you, actually. So a lot of people endorse it, and then this project catches the attention of people. And I'm going to play you a little bit of this video so you understand how this so-called box works.
Right. And maybe that happens until there are $200 million in the box. So, sophisticated traders and or people on crypto Twitter or other sort of similar parties go and put $200 million in the box collectively, and they start getting these X tokens for it, right? And now all of a sudden everyone's like, wow, people just decide to put $200 million in the box. This is a pretty cool box, right? Like this is a valuable box, as demonstrated by all the money that people have apparently decided should be in the box.
Right. This is a key point. He says, as demonstrated, right, by sophisticated traders. This is another lesson for you. There's no such thing as smart money. There is such a thing as smart money, but the smart money will never show you what they do. When they advertise what smart money does, then you should be wary, right?
Yeah, basically there's an expression, trading your book, right? So when you're out there walking about how
talking your book,
I'm sorry, yeah, absolutely, sorry, talking your book, not trading your book. Yeah, so you're out there, you're talking your book so that other people get invested in it and run it up. This is a very similar concept. I mean, now every time someone talks their book does not mean that there's a Ponzi scheme going on.
Yeah,
but,
no, I'm not saying that, but that should not be
I know.
any factor in your decision making, right? You should not buy Bitcoin when everybody's high about it, right? When it's $60,000 and everybody's saying it's going to be $1 million, and then every day famous people come out endorse it, that is not the time to buy anything.
Well, I mean,
that's risk management.
Yeah, the point is it's not that it is the time or isn't the time to buy it. The point is that you need to be doing your own research and see what you think about that going up to $1 million.
Maybe that's true, but partly it shouldn't be a factor, but also sometimes when there's too much hype from celebrities and all these people, right. Our show is called Counterpoint, right? So the counterpoint is that you should be a counterpoint to what's going on to some degree, right? So let's listen further.
And who are we to say that they're wrong about that? Like, this is, I mean, boxes can be great. Look, I love boxes as much as the next guy, right?
Look, they're laughing. And this was before.
What happens now, all of a sudden people are kind of recalibrating. It's like, well, $20 million, that's it? Like that market cap for this box? And it's been like 48 hours and it already has $200 million, including from like sophisticated players in it. So like, come on, that's too low, right? Like, and they look at these ratios.
So this is where I wrote a bunch of articles in 2018, 2019 that value investing is dead. It was dead, right? But I don't think it's really dead. It was just blown away in the madness. The point is that value investing is the only real kind of investing. Everything else, it could be very profitable, but it's something different from investing, I think. So I think we're in a situation where if you want to avoid these types of things for risk management, you have to think at least to some degree about the value that is provided. And here, what he's saying is that this is completely dissociated from value. It's purely psychological. FOMO, right? FOMO, fear of missing out. You're afraid that you're going to miss out on the next big thing. It's a psychological confidence.
Well, yeah, he's saying the value is because other people see value, but other people see value, it's value. So it doesn't, you don't really care what the value, you don't really care that it's a cardboard box. You care that other people think it's valuable.
And that's not value, right? That's the whole point. It's not value. Value is where you have some metrics where you measure value. Right. And then what else,
TL, total value locked in the box, as a ratio to market cap of the box's token. And they're like 10x, that's insane. 1x is the norm. And so then, X token price goes way up and now it's a $130 million market cap token because of, the bullishness of people's usage of the box. And now all of a sudden, of course, the smart money, it's like, oh, wow, like this thing's now yielding like 60% a year in X tokens. Of course, I'll take my 60% yield, right? So they pour another $300 million in the box and you get a cycle, and then it goes to infinity. And then everyone makes money.
Goes to infinity. I think of myself as like a fairly cynical person. And that was so much more cynical than how I would have described.
And this is Matt Levine, a very
you're just like, well, I'm in the Ponzi business, and it's
look at that, the Ponzi business, right? So this is what they say.
So I mean, so here's a picture. Like basically, he's basically telling how his business works, and he's describing a Ponzi scheme. And this guy,
and it didn't ring any alarm bells for anybody. The guy kept being invited to major conference. I mean. Andrew Ross Sorkin on, I forgot was it CNBC? The financial.
I'm not sure what he's on, but he's written a lot of books and movies.
He called him like a Michael Jordan of crypto or something.
Yeah.
Warren Buffett of crypto. I mean, like all these accolades came up. And so, look, this FTX collapse is a great lesson for everybody. Like, you shouldn't just focus on the hype. Oh, it collapsed. It's crypto scam. No, Bitcoin's not a scam. Yes, Bitcoin could come down. It could totally be overvalued, but there's none of this Ponzi element, right, where people borrow and leverage and get away with things. So I think this is a wake-up call. They just described on this podcast the way every one of these things work. And unfortunately, I will go further to say this. They just described how some of the tech stocks work, Jan. I know this will sound very controversial, but some of these tech stocks that went up, you see, the difference is that they went up when interest rates were zero. If interest rates were zero today, this business, I shouldn't use the word business, but it wouldn't collapse. they would just be able to borrow and stay alive until the storm passed, and they would gobble up more companies and survive. So what you have to understand is elements of this in a lot of businesses today. If you read, I really recommend economist Hyman Minsky. I don't agree with all of his theories, but it doesn't matter. He was an extremely brilliant guy, and he wrote about, there's a paper, it's not even a book, very easy, financial instability hypothesis. Look it up, read it. I'll put a link below the video. Financial instability hypothesis. Essentially, his hypothesis is that during a time of easy money, the economy transitions from business to Ponzi. That's the exact word he uses. And it doesn't mean Ponzi in the sense like a Ponzi, straight out Ponzi scheme, but that many businesses, real businesses, they could produce cars or something, they acquire characteristics of a Ponzi business. So what they just on this podcast, they did a favor for you. They described for you how a Ponzi business worked. Now, the fact that his FTT token, was kind of easy to see through, I think, that shouldn't obscure the main point. There are many tech businesses that operate the same way. What do? They issue a token. Their token would be a stock. They would use that stock overvalued to borrow money at a very low rate. And then they would buy other companies and buy growth rate. So they would do all kinds of things, or they would go the other way. First, they would borrow money to buy back their stock to drive it up. Then they would use it. So there's all kinds of stuff going on. You should be mindful of that the company should earn money. It should grow because of some real earnings, some real business. And that, I think, is a wake-up call. In the next few years to a decade, I believe, those investors that unlearn all this momentum chasing and all these things, they will do much better.
Can I just say that I love the graphics that the people are doing in this video. They got the guy with the money, and they and the filling of a box with this is like visually representing what this guy's saying on the podcast, because that was a podcast and we're watching a video, but it's really kind of brilliant.
Yes.
Now you said you said one thing to me earlier before we got on the air, though. You said at the end of that Matt Levine actually, so after he identifies it as a Ponzi scheme, at the end he's like, I don't think he says I'm a believer, because I didn't watch it, but something like
Matt Levine said some positive things about him after the podcast. He should have been warning everybody to take to
watch out.
But I don't know what he should have done, but not say anything positive about this, because he himself, being an astute person, called him out on this, right? And this went sort of unnoticed. In real time. Yeah.
He called him out. Yeah.
And I will, one other thing about this, I'm going to show you an article that was written about Sam Bankman-Fried before the bust. And there's just too hilarious. I don't think there's any real lesson from it, but it's just too funny. I wanted to share with you. It's actually,
there might be a lesson. Yeah. I think there's a lesson from it.
Yeah.
It was only published on September 22nd, the article that you're going to, well, let's show the article, and then we'll talk about the lesson.
It was scraped from many websites, from all websites, but it's available in the internet website.
Yeah, they took it down. So published September 22nd.
This article, a very experienced financial journalist who wrote 3 books, strong books, he basically says that, according to him, his opinion, SBF is the world's first trillionaire. He's going to be the world's first trillionaire. And then I have to read this. Oops. You can't get enough of this. So to be clear, SBF is not talking about maximizing the total value of FTX. He's not about that. He's talking about maximizing the total value of the universe, Jan.
Well,
when you hear words like
Daniel,
that.
On this podcast, many times, though, I have said, I think the universe is undervalued. We need to maximize the value of the universe. You've heard me say it. I've said it like, to go back to the earlier videos. I've said it many times.
Well, unfortunately, you couldn't do it. And these units are not dollars. It is a kind of GDP for the universe. These units are units of utilitarian. Sam Bankman-Fried was a member of a society called Effective Altruism. Sorry. So So he's maximizing utils, these units of happiness, and not just for every soul, not every living soul, but also every soul, human and even animal. I don't know if he includes like bacteria or not, but that will ever live in the future.
Be reasonable. They're not talking about bacteria, just humans and animals and like rats and squirrels and stuff. Not bacteria. Come on,
right.
That's silly.
That's right. So maximizing the total happiness of the future, that is the goal. And FTX is just the means to that end. It's just the means to the total value and happiness of all of us. So you young, and I don't mean to make light of people losing their money. It's very sad, but we live in a time where there's a lot of tough things that are happening. You can't cry all the time. I feel very bad for people who lost the money. I'm not laughing at it, but I will say that with that one quote, the journalist achieved at least part of that goal. I think he maximized my happiness for today because it was a very difficult day, and every time I read that quote, I just laugh.
Yeah, but it's going to go away tomorrow. So he didn't actually do it for the future. So that's that thing. But I think the lesson that we can learn from, there is a lesson. Whenever you see this sort of Masonic type of writing about somebody, like this person is the second coming of Jesus Christ or something like that, or whatever you believe in as a religion, when you see someone writing about somebody like that in those kinds of terms, and what they're doing is they're running an exchange. But this is like,
right.
you
have to see some results. You have to see some results to prove that. What are the results?
But come on, you whenever you start to put someone up on this pedestal like this, like you're worshiping what they do, and this is like, everyone's.
I can understand if he gave away all of his money, he would live in a small apartment and went to feed the hungry and so on. There are a lot of hungry people in the world, and even some in America, but there was no results, right? This was all a conjecture.
Yeah.
I don't want to turn it into cynicism that anybody who talks about the happiness for humanity, now all of a sudden he's a crook. Everybody has to be like Gordon Gekko, not my favorite character. I'm not saying that, but in all actuality, situations like this, they turn the world more cynical, unfortunately.
Look, here's my for-profit company. Invest with me because I'm going to maximize the happiness of the universe after you make me rich. I think I think we can all agree that you can be pretty cynical about that's essentially the message here. Yeah. I'm not really about me being rich, but I'm going to buy my parents $120 million, slice of the Bahamas. And I'm going to do all these kinds of things with my money, which benefit me, but I'm not really in it for that. I'm in it for the universe. Come on.
That's right. Well, he also openly admitted just days ago, I read where somebody texted to him, is like, what about all this altruism? And he actually wrote, hey, like a laugh in chat. And he said, this is just the dumb game that we woke Westerners play. So he, even now he's kind of joking about it. But anyway, let's not end it on a bad note. I think it's a lesson. Yeah, people lost a lot of money, but I think they could have lost a lot more money had this gone on. And maybe it's good that it ended sooner.
Yeah.
Right? And maybe we'll end our podcast sooner on that. With our video on
that note. Not a bad place to end it. So
right. Happy Thanksgiving. And we'll see you in the next episode. Don't forget to subscribe.
See you in the next episode. Bye, everyone.